Suddenly one idiot is coming in front of you, you have to.
That's why I said 0, because today I came by Uber.
But that is another decision. You decided to come by Uber is a decision. So every single moment of our life is we are coupled with, we are forced to make decision. The color of dress that I want to wear today is also decision. Okay. Who is the best decision maker in terms of profession? In our different profession, doctor, pilot, engineers, accountants, teachers, drivers, likewise, what do you think, who is the best decision maker? Anyway, at least to my understanding, maybe I may be wrong. Yeah, tell me an answer.
Myself.
You are the best decision maker, yourself. For yourself. I'm talking about the profession.
The top management.
No, top management may have all these examples I gave you, no? Driver, engineer, doctor, scientist, everyone will be there.
Is this a generic question?
Generic, very generic question.
Every individual is a decision maker.
Yeah, but who is the best?
Who thinks about the consequences?
My understanding, the vehicle, you need more information to. One who has more information. See, my understanding is the driver is the best decision
Yeah,
maker.
he's having a lot of lives at hand.
The sudden, well, last week also we talked about speed kills and thrills, speed thrills but kills. So he will be very, in the microseconds he had to make a decision. Because of that, the things can change in a whisker of second. Anyhow, this topic is very vitally important to understand whether should we take up an action or not. There are two types of decision making. Short term and long term. There are short term decision making and long term decision making. So to talk about the short term decision making, one of the short term decision making is pricing. Now I produce a good or service. At the end of the day, I need to understand what price I should sell this, and I should be able to attract customer to sell this at the price that I am quoting. Now we had an era in the past. Before we didn't have Uridu, we had Qtel. That time we had Vodafone? No. How many of you remember this telephone booth outside on the roads? All of us. My experience at least, I came to Doha in 2003, and we, in new time to come to this country, we always factor our cost based on our country terms. So in 2003, at least for 1 year, I decided not to have a mobile phone. And my understanding is very expensive. Land phone is the booth. Me, my wife and my younger brother, we three of us together, we bought one card and we kept a book. We record, okay, I speak to my mother 10 minutes. And my wife speak to, and I'm very careful how many minutes she is talking to her mother. So that was the mindset that time. And that time usually 1 minute mobile phone charges
7 riyals.
My experience is around 6-7 riyals per minute. Very expensive. what also we do, now then I had a time when I forced to have a mobile, that is Nokia 3310, and also used phone. Then prepaid, Hala. Now only Hala, that time I don't know whatever the name is, it's a prepaid service. We never take outgoing call. We find a guy who has a postpaid service and the bills are paid by the company. So that's how our mindset is. So at least for that extent, we are thinking of managing our cost. So 1 minute, 7 real. And then later, QTEL has changed to Uridu and the technology developed, and then the competitor walked in, Vodafone came. Now after the Vodafone arrival, the Uridu has forced to reduce this to that extent, and so many other options now communication came in. Now we are not worried about these minutes. Everyone's phone maybe have 1000 minutes, 2000 minutes, unlimited minutes, and then we are now waiting, you need call from me. That extent our mindset now. So now these services also very important in deciding the price. Now what the concept I wanted to say, there is economically there is something called monopoly. What is monopoly? Only a single service provider performing the services for throughout the public. Many customer, but only one supplier. So QTEL had the domination on the pricing, but then later the competitor walked in. This monopoly has changed to there is something called duopoly, meaning like that. So however, one of the important aspect of short-term decision is pricing. Before you do the pricing, you need to understand in which market you are operating your business. Now, if you walk to Matar Kadim area, I hope everyone knows Matar Kadim, both the side of the road there are too many restaurants, and mostly Asian or Indian restaurants, a few Sri Lankans also there. You go and ask how much is one biryani. More than 90% of the time, the price will be same. If they try to change the price by 1 real, plus or minus, within few days you need to close your business. You accept that what I'm saying? Because you cannot reduce the price. Why? If you reduce the price, customer will be happy, of course. Maybe initially more customer will come, but you will not be able to manage your fixed cost, the rent, the salaries, and so on. If you can't increase the price also. Why you can't increase the price? No customers will come to you. Then you end up, both the scenario, you would end up closing the business. So therefore, you have to operating prior to understand or to have the pricing. Now, for you to further work out, now my selling price is equal to cost plus profit. This is a normal equation. My selling price is cost plus profit. Cost, we talked about it. Now, this profit could be either margin or sometime markup. I think last class we talked about it. So you have to appropriately arrive your profit in finding out what is your selling price. This is one of the examples for short-term decision making. Now, in your business, how could you relate this? The price. Now, your property business is not. I would name it as like a luxury level properties. So you may have certain given competitors. Correct? Not every real estate providers are not your competitors. Your competitors may be very unique, maybe few. We can count it by fingers, 3, 4, 5 like this. It's not 20, 30, 40. My understanding correct?
Yes.
Okay. Now, for you to arrive, your pricing to your customer, what is stopping you from looking at, I mean, what are the factors helping you arrive your selling price? The competitor price information, market. So, market price information, we have to have a good understanding. That analysis has been continuously carried out. Economic conditions of the country. Yeah. So, these two interrelated. Economic condition and the market. And what about the quality of your properties? Now, your property quality and your competitor property quality may not be the same. If your quality of the property is very high, although the competitor is charging $2,000, you may force to charge $2,500. Is that clear? Still, do you think how you could attract your customers? Facilities. So there are non-monetary factor or value additions which you need to add on in order to attract your customers. So one decision make, pardon? Brand, yes.
So the brand speaks for everything.
Who are your customers, if I to understand? Is like a general public or commercial sectors or general public? It's both. So in the market, in the Qatari real estate market, your organization has that special brand. So if I to sign up with you, I have hassle-free life in this property.
Yes.
So that branding
Yes.
is already there. Fine. So here in arrive facility management cost. So number one is pricing. Number two, shutdown decisions. Sometimes you may experience on your neighborhood or on the road. Last week you may see one restaurant. This week that shop is totally empty. They have vacated, they have removed it, they closed it. So what do you think about the shutting down? Is an easy exercise?
No.
It's a very tedious, difficult exercise, because when you started running up a business, you have already undertook so many liabilities. Your employees, your suppliers, the government consequences, and even your customers. So if I think today I am shutting down, I just can't shut down by tomorrow. I had to manage my eventualities of the decision that I am took about shutting down the business. So shutdown decision will escalate into perform various different future calculations. Like for example, rental. Now, okay, if I took a property from you, after 4 months I come and tell you, my friend, I had to go out. Then the consequence is that how I manage my fixed cost. So secondly, staff. I may have hired 10 people under my sponsorship. So then I need to close it. From a business point of view, we have something called termination benefits. Compensation benefits you may have to pay. Plus, from a legal point of view, you need to ensure their rights are managed. We don't want to see that fellow goes to labor courts and then put us into mess. So that is the second scenario. Thirdly, our suppliers and also our lenders. the bank, finance providers, and also if I'm a non-Qatari or an expert, I'm running a business and I had to close this. So then I need to manage my sponsor also. So he may also have various expectation or terms which all needed to be immediate, prolonged. You have to find out, if you shut down today, what are your consequences? Or after 6 months, after 1 year, what is best for you? You shut down now, then you now think, okay, I need to reopen it again. That is another eventuality which you have to incorporate various calculations. One thing I would like to talk about, let's say I have 3 divisions, A, B, C. Sorry. This is okay? Or I will change it to blue. This is fine. White is where? I will try this. Much better. Thank you for that. Let's say I have A, B and C. 3 divisions. Now, and the total. Now, division A, now it's a profit or loss. Division A, I have a profit of 400. Division B, I have a loss of, that is 450. Yes. Now, if you looking into the division B and based on the bottom line, our understanding may advise me that it is better you close this. Correct? But looking at the, now this line we call it bottom line, and this line where you have the sales is known as top line. Now purely looking at the bottom line, if I decide to close this, would that be a feasible option? That's what we need to think about. As we understood, our total cost categorized as to variable cost and fixed cost. And regardless of the action that we will take, will there be any change to my fixed cost? No. Only change will be my variable cost. Let's say my sales here 1000. My variable cost here 600. So this difference between 1000 and 600, from a costing point of view, we name this as contribution. How much is my contribution? 400. And the fixed cost that I am setting up for this is 650. So that's why I am having a loss of 250. Now the question is, this 650 given to B is, we name this as, we apportion this. The fixed cost, for example rent, you take a factory in full, but within factory you make a production of A, B and C. So the rent you pay in full. So whether you produce 2 products or 3 products, still the total rent you need to pay. Correct? So therefore, what from a management accountants, what they do is they split this in order to understand the performance of each of these products. Now, scenario where I'm having a loss of 250, so we are thinking of shutting down this. If you shut down, if you totally close this, what's going to happen? You're going to lose this 400 also. Will there be a change to fixed cost? Fixed cost will never change. Now let's say for total, your fixed cost is 1900. Now even you close this B, still your fixed cost is, but what is going to happen? You will not have this. 400 is a plus, you see. And if you lose that, is it a good situation? From a total point of view, it is not a good situation. So what the advice is, before you decide, you need to understand the individual line items under each category. So that is third one, reopening also another decision making. Now these are part of short term. The long term decision making is a topic that I will not discuss here. The one example is purchasing a property. Then if you had to purchase a property, you have to do something called investment appraisal. Whether that investment is worth enough or not. Maybe if that exercise is a different scope, we will not discuss in this session. So this is about short term decision making. Any question or how we can relate this to your business? Any scenario you would like me to discuss this, or otherwise I can progress to our next topic. What do you think? Yes, brother, you okay? So now we talk about budgeting, probably one of the important topic, and you may be day to day in your business life you are encountering. From your understanding, what you think, what is budget?
Reserve the amount for. Reserve the amount.
Reserve the amount for? Okay, I will note it down. Any other?
Yeah. Planning.
Planning.
Yeah, planning.
Planning. Any other?
Finance plan.
Finance planning. He is qualifying the statement. Any other way to define what is budgeting? Forecasting. Yes, madam, what do you think?
The highest,
Now, yeah,
highest cost to run business.
highest
Cost.
cost to run any service or produce a product is what you're saying. Everyone, yeah.
It's a plan in numbers to safeguard yourself not exceeding your
Plan in numbers to safeguard.
your business plan and ensure that you're not exceeding your means and stick to your income plan.
And ensure your means. Okay, I will rephrase another question. In every one of our country, our government, do they make budget?
Yes.
Do they announce it?
Yes.
They announce it. What is that document speaks about? Have you ever read any of these budgets?
We heard the number.
Yes.
How much period? Every year.
Operating.
Operating. Allocating. One of the important word here, allocating. See, the budget is, let's say, and let's please give me a monthly salary number. Let's say 2,500. That is his salary. We'll assume like this. This 2,500 is his monthly salary. Now, normally, we have like 1 to 30 days. He will receive salary somewhere. If the company is very good, he will receive the salary somewhere here. So he will receive 2,500 here. Now, I will also tell you my experience. When I reached Doha, as I said, 2003, when I received the salary, that time no bank account. They put the salary into an envelope and they give. I soon come home, I have like another 4 or 5 different envelopes. Food, X, saving, Y, family, like that. I distribute the salary that I got, and then finally I find how much I have for entertainment, and then I scratch my head. So the word is that now with this 2,500, he has to plan for the next 30 days. He has to live here. So he need to have food and beverages. So that is one important factor. Other one is the rent. We don't pay the rent unless the company is paying his rent. He has to pay the rent. Then he also have lot of commitment back in his country. So he need to, as we said, we need to send to family. And then maybe a communication cost, internet, Urdu, and so on. For any unfortunate situation, medical. Unless this guy has the this 100 real health card, he has to go to Esther or somewhere. He has to pay for extra money. So the food cost. So these are line items. Now he has to allocate this line item here. Now what he has? 2,500. This 2,500 we would name it as resources. The budgeting is an allocation of resources for the given future period. Not the term given, fixed. It should be a fixed future period, like a month or quarter. Normally, in any organization, that given future period is 1 year, one fiscal year. Yes. So, budget is the right definition of budgeting is an allocation of available resources for a given future period. Is that clear? And what we said now, is it meeting to all of us what we are write down here?
Yes.
It is all meeting, but not precisely coinciding on top of it. Now, if I draw a circle and if I name this as budgeting, and you see now I have a word here, planning. Now, planning, that circle is smaller than this or bigger than this. See, I'm thinking, okay, in 2 years' time, I need to build a house in Sri Lanka or in India or wherever. So that is one of my planning. That's actually more broader than my this limited given period allocation. So the planning will come a bigger circle. Now in between, all others will fall in. Now even forecasting even that is much, actually forecasting is here. Hope you understood now. So the very first thing that we need to define, the allocating available resources for a given future period. Now another question, these resources are unlimited or limited? Limited. If it is unlimited, do we need to allocate anything? We don't need to. Since it is very limited only, we need to prioritize using the available resources in the right way. That's why this fellow has to think about all this. Understand me? So, can I erase all of this? So, this is allocation of available limited resources for a given future is budgeting. So, how you are doing the budgeting? Mechanism. Yeah.
Actually, watching the previous year, what was the expenses, to have the most accurate calculation for the upcoming year.
Okay. Very ideal way of doing budgeting she is explaining to me. Any other possibilities? There is something, yeah, there is something called types of budget. There is something called types of budget. Anyone can refer or help me know exactly? So one budget is known as zero based budgeting. I will discuss this, but let's list down all the types.
From the previous year.
What she said, that is known as incremental budgeting, and also we have something called rolling budget, and also we have something called so normally we categorize into these four headings. Now let's first discuss incremental budgeting. So to 24, and my maintenance cost is 2,675,000. This is my maintenance last year. Now you have been asked to prepare a budget for 2024. What typical managers they will do, they will go back to 2022 and find out how much was the actual for 22, and then they have the information for 23, then they find out the movement in terms of percentage. Then they will apply such percentage over here. A typical way of doing this. Whether it is right or wrong is a different question, but this is one way of doing it. Now, then what could happen? Now let's say he is adding 10%. For the simplicity sake, I am writing it 3,100. But now these are budget numbers. Okay, these are budget. Now what about the actual now? After every year, first day of that year, I will set up the budget and produce to my management. They will then approve, and that will be introduced to our system, our SAP or Oracle or any system. They will capture that budget, and that will be freezed. Every time you will go for an expenditure, that will go and refer to the availability of that budget. Accordingly, it will get approved. A point when your consumption exceeding the amount of budget, it will go to the next level approval. So that's a different software management. But here, now I have my actual. Let's say in this case, my actual is only 2,100. What was my budget? 2,675. But my actual is how much? 2,100. That means I have saved how much? 575. When the management will see this, will they be happy or unhappy? Will be very happy. Now, I would reverse the coin now. The man who developed the budget, what he has done, that understanding the reality of the actual expense, he has added fat or extra muscle in setting up this. Now, for example, this is 2,300. Okay, and he has checked here, it was around 1,850. Now he understood, okay, let me make like this. So I am sure next year my actual will not reach into this. So management will, congratulate me and pay me extra bonus because I have done such a saving. This exercise is known as budget slack. Is it a good exercise or a bad exercise? It's a very bad exercise. I'm sure I know that 2,100 was my previous actual. So my budget should relate to this. So many budget preparers, they engage into this. Have any one of you came across this? Experienced this? Probably you may have not used the name. Budget surplus is where from your you end up generating more than what you set it. The difference is surplus. Again, it's a clever thing that they are believing, but again, that's not a right practice. So these all are part of incremental budgeting. What do you think? Incremental budgeting is valid now? Will that be efficient? In other words, it is not efficient at all. Incremental budgeting is a very conventional, traditional, old school of thought and must be discontinued. So that is the first one. Second one is zero-based budgeting. Can I erase the board?
Yes, please.
Yeah, you have a question? Okay. Zero-based budgeting. Now we understood the nitty-gritties of incremental budgeting. So the theorist came up with this method. Now look into this. 2021, 2022 and 2023. Now when you have to develop budget for 2023, using incremental budgeting, what we have done, we followed the previous years. But now this zero-based budgeting, what they are saying is, you look into each and every year on its own perspective as a new year. And also you connect or think that no relationship between the years. As if the business found in 2023. You do not have any previous experience. So fresh outlook of what the required elements of your cost and revenue on this basis. That is zero-based budgeting. Third one, so I hope this is clear. I could go into more detail, but it is not required. So any question before I go? Any of, yeah.
This is zero-based budgeting is relevant for the service industry.
More appropriate for, so even your business,
Yes,
it is much better you utilize zero-based budgeting, provided your team is helping you, and the software also should help you.
and it takes time.
Yeah, the software or infrastructure, I would use the term infrastructure, should help you in arriving or preparing zero-based budgeting. Also, another problem, transition from incremental budgeting to zero-based budgeting is not an easy task. So,
Saying this is adequate for our line of business.
yes, more appropriate is this. Or because when it comes to the service, your business is service industry, the understanding the requisite numbers from a fresh view is much appropriate, because it may not be relevant to take from the previous numbers. Your conditions may change, your contributing element to form the budget may change, likewise. Now, there's another point is that change management. What do you think? The changing the mindset is easy. Changing the mindset. Easier if someone will come and tell you that, okay, I have taken this mountain from point A to point B, believe him. But if that guy says that, okay, I have changed this fellow's mindset, do never believe him. That is our Prophet Muhammad's one of the phrases. So, it is not that easy in changing the mindset. So, there is also another saying, change the person. If the person is not changing, then change the person. That is more easy. Anyhow, so zero-based budgeting would be the second method. Third one, rolling budget. Let's say I have quarter 1, quarter 2, quarter 3 and quarter 4. In a year we have 4 quarters. So I developed my sales budget for quarter 1. This is 2022. Okay. So I developed my sales budget for 2022. Quarter 1, let's say I have 450. Quarter 2, 512. Quarter 3, 390. And quarter 4, 675. Some numbers. Now, when you move to 2023, first quarter, that is quarter 1. Now, you see, I have prepared budget for how many quarters now? 4 quarters. So, if you want to adopt the rolling budget, when you reach to quarter 1, what you're going to do? You will the previous year, and then you will add the let's say 590, the first quarter of the second year. At any given point of time, the total budget will have how many quarters? 4 quarters. But every time 1 quarter you will achieve, the previous quarter you will remove. So if it is quarterly basis, if it is monthly, every 1 month. So the total number of months in the budget will be 12, but every single month will be excluded and 1 new month will be included. So this is the role. What is the advantage? Why you need a rolling budget? In order to understand the local requirement for the, see, this is a new situation, right? So we could easily adjust our budget. No. You prepare budget, in this is one example. You prepare budget quarterly in this example. So 4 quarters you prepared. So accordingly, No, this is prepared for 4 quarters, meaning 1 year, but they have adopted quarterly based style.
So you have to revise each quarter.
Exactly. But if it's like month 1, 2, 3 and 12, then when they reach to the 13th month, then what they will do? They will remove this. So they will then keep it in total of 12 months. Clear?
Is this budget model widely used in large scale business? This rolling budget?
Yeah. What is the meaning of this, brother? I have now in the previous methods like incremental budget, I will prepare a budget for 2024. Let's say monthly. So January, February, March, up all 12 months I will have. So when I am adapting my actual situation, I will just compare with my budget and my actual. But in this method, when you complete any given month, let's say February 2024, you completed, you will then prepare another budget for another 12 months, starting with that February 2024 for the next 12 months. So every month you complete, every new set of 12 months you will have.
So every month you have to do
Exactly.
new budget.
Exactly. Exactly. In the sense you will only do 1 month. See, now if that 2024,
I mean, you have revised the other 11 months.
no.
You will just add one.
Yeah, you will add one and then remove one, add one and see. Now you have 2020. Let's assume we have January to December 2024. Now you reach to 2000. This is a budget. So first month January 2024 was the actual. You complete that. Then you will see what is the result and you will do that month budget and actual comparison. In addition to that, you will also prepare 2025 January extra month. Then you will have another 12 months. That's what the benefit is, brother, to find out the real locality. After seeing the January 2024, more than what you budgeted, it is situation much different. So that will give you additional knowledge in
But I will not change February. I will change only January 20.
the next, correct. So then you will at least know that what is my current January month change would bring for the next 12 months. So that is the understanding. So this is the rolling budget.
So this budget, this kind of budget is applicable for real estate, for our business.
You could use it. Nothing is stopped doing it.
More
Much better is zero-based budgeting.
Zero-based budgeting not work for us.
Not work for you?
It should be actually for us mix.
Incremental budgeting and
Incremental plus-
yeah, that is another point of view. It's a combination of different set of budgets which is more practically applicable to your business.
Google says zero-based budget is good. Previously.
Yeah, see, Google may say more theoretically, but the problem is the locality and reality is not necessarily same to what the Google is. Budget formation, how I develop a budget.
It is still certificate-based budget.
Yes. Sorry, I did not discuss that. Thank you for reminding me. So let me discuss that and then we'll come to this. You see, I would use a term here. Although the letter C is not there, but still I will write ABC budgeting. There is something called activity based costing. So when you we will discuss after this about this, but when you understand what is activity based costing, it is actually you develop your cost, your products and services purely based on your activities, not based on functions. So classification of the cost, if it is based on function, we call it historical. If it is based on activity, that is exactly what we mean activity based costing. Now in activity based costing, what we try to do, we try to find out, now let's say I want to understand the increase or decrease in cost. That's the requirement. Now the mechanism in finding out increase or decrease in cost under functional method is normally output, the quantity. We talked about that. The variable cost will increase or decrease based on the output. But under activity based costing, it is actually based on certain drivers. We name it as cost drivers. So what are cost drivers? Let's say, for example, you remember that video last week we watched, and that lady was saying, there's a factory, they manufacture spoon, and there's a salesman or there's a person who is doing the packaging, and then only it goes to the sales. So the number of packaging they will handle will result into increase or decrease in the cost. Correct? So that packaging is one example of activity. Or we also watched in that video, there's a person who is managing the orders. You remember one image, the person was sitting with a computer. So there is a person who is doing the order management. The order management also will escalate the cost. So these are examples of what? Examples of activities. Because of these activities, the cost will increase or decrease. From activity based costing point of view, these we name it as cost drivers. So plus or minus of this will increase or decrease that cost categories. So because of this, your cost category will increase or decrease. That cost category also named as is all about activity based costing. And if you use your budget using this principle, that is activity based budgeting. Very highly unlikely applied in normal businesses. And this activity based costing was introduced by Japanese. And there is something,
Small scales.
yeah. And pardon? Exactly. There is also, I am sure you all know what is TQM. What's the full form of TQM? Thank you, Masalama. Total quality management. And also there is another term, just in time. So they came up with these, and also Kaizen, Six Sigma, everything related. And this actually was introduced by a gentleman named Robert Kaplan, He is actually a US guy. He tried to implement this in US. No one accepted. He then flown to Japan, and then exactly in Toyota. So Toyota, what is the right name? What was the owner's name actually? The owner's name is Toyota, something like this. Maybe my spelling is wrong. It's not Toyota, it's Toyota or something. So they only implemented all this mechanism. From there only this costing mechanism came. From that the budgeting we moved to formation of budget. How I develop a budget? Or what are the input that I need to have a budget? Have you seen budget documents?
Yes.
Yeah, tell me what have you seen?
Budget.
Yeah, in a budget what you have seen?
There is the revenue and the cost.
Yeah, he says that he has seen the revenue and cost. Any other interpretation? Actually, budgets are divided into when talking about formation, we have two types of budget formation. One we call it master budget. A master budget will have a budgeted income statement similar to an actual profit and loss account, but it is budget. Then budgeted balance sheet, or the new name is statement of financial position, and then budgeted cash flow. So these three documents in the financial statement also available, but those are actual. So these three documents together we name it as master budget. But before I prepare the master budget, I have to prepare something called functional budget. Every business will have different functions. If I pick an example from manufacturing EC, I will have different functions. I will have production function, sales function, purchasing function, human resource function, automation function, sales, what you call selling and selling expense, meaning marketing function. Likewise, I may have different segment of function. So if I write, I will have sales function, production function, then purchase or procurement function, then I have human resource function, then I have other functions. So I have written like this. So these are some examples of function that I have. Now where to start? From which point I should develop my budget? Now go back to this this carpenter who has 2,500 real salary. When he started developing his budget, what is his starting point? The available resource 2,500. From there only he need to think. So we understand that that resource is limited, correct? So whatever the limited function among this list, that's where we need to start with. There's something called principal budget factor. Now, if units, is there any point that I make a budget for producing 5,000 units? No, correct? When my demand is limited to 2,000 units, I should not be producing 5,000 units. So what is my principal budget factor then? The sales demand, correct? So the principal budget factor in this situation will be sales demand. I'll give another example. Now my sales demand 5,000 units, but my factory production capacity, I can only produce 4,000 units. Then my principal budget factor is not the sales demand, is the production capacity. Accordingly, you have to decide and change what is your principal budget factor. When break even, we know that total revenue is selling price into quantity we sell minus total cost. We know that total variable cost plus fixed cost, that also we know. And we know that selling price into quantity minus variable cost per unit times quantity plus fixed cost is equal to 0. Now we do a little more on this. I open this bracket. If I open this bracket, selling price times quantity minus variable cost per unit times quantity minus fixed cost is equal to 0. Now what we do is we couple these two. You can see that here I have quantity, here also I have quantity. Then I will do a factoring on this. So quantity times selling price minus variable cost minus fixed cost is equal to 0. From a different costing theory point of view, we have a terminology called contribution. What is contribution? Is the selling price minus variable cost. So therefore, you can see here I have selling price minus variable cost. So contribution times quantity minus fixed cost is equal to 0. So now what I do, I move this to this side of the equation. So contribution, this contribution is contribution per unit. This is contribution per unit. So therefore, the quantity will be equal to fixed cost divided by contribution per unit. Meaning, in a break-even situation, how many units you need to produce? Units are quantity. How you calculate? This is the equation. So you need to have your fixed cost divided by contribution per unit. How you arrive? Using this. The arrival is not important. You don't need to know. But for the sake of understanding, I have given. So therefore, break even point in quantity will be fixed cost divided by contribution per unit. You understand me? Now what do you mean by this? Well, we again understood that my total revenue will be equal to total cost. That is an understanding, should we continue my business or not. Let's say my total revenue is 10,000. My total cost also 10,000. My actual revenue when come to 9,000 or 12,000. Which one I should be continue doing business? If my actual revenue is 9,000 and my total cost is 10,000, no point of doing this business. So the analysis of this knowledge is telling me whether I should engage in this business or requirement. So and I will continue this. There is one more thing known as CS ratio. What is CS ratio? Look into this example. I have selling price $10, my variable cost $6. So my contribution $4. So what is CS ratio? Is you take this number, divide by this, and then multiply by 100. So you get 4 divided by 10 times 100. Your answer is 40%. So that is your CS ratio. Now let's take one equation is this. The second equation, break even point in dollars. Now here what I have written? Quantity or units. Here it is dollars. So calculation, break even point in quantity times selling price. Is that clear? So you know the number of units, 10,000 units in that example we said. Let's say selling price is 10. So break even revenue will be 10,000 times 10. It will be 100,000. The same thing we can arrive, break even point in dollars will be contribution divided by CS ratio. I'm sorry, not contribution. I made a mistake here. That is fixed cost. Fixed cost divided by contribution. Now let's say my fixed cost is 40,000. My fixed cost 40,000. So let's apply this now here. 40,000 divided by 40%. Where is that we calculated here? 40. Correct? So you can arrive this way or this way. So this is break even point in revenue. So overall, what the takeaway that we are taking from this knowledge of break even, whether it is worthwhile I am engaging into this business. So in your property business also, what is most important to understand your total fixed cost, regardless of you have your customers or not. Once you have your property with you, you still need to engage with your fixed cost. You need to incur that. So what is how I should be setting up my price and how I attract my customers in ensuring I am recovering my minimum revenue. If I am not recovering this much revenue, it is not worth engaging into that particular property. So that's the knowledge that we are looking into. So one equation is this. Second equation is, and the third equation is, we also have some graph to understand this. Can I erase all of this? Selling price $10, variable cost $6. So contribution per unit is $4. Fixed cost 40,000. And this one units, and this is the cost. Let me first sketch the fixed cost diagram. How much is my fixed cost? 40,000. Regardless of I am producing 0 unit or I produce 10,000 unit, still one second. My total fixed cost will remain the same. So let's say that go like this. And my revenue, we produce, let's say, 12,000 units. Okay. So total revenue will be, when I produce 0 unit, how much is my revenue? 0. When I produce 12,000 units, my revenue will be 120,000. This is 40. So this is 12 and this will be 120. So what you do? Made a mistake. What happened? Yeah. Again, it has gone down there, no problem. So let me say this is 120. So this diagram is known as total revenue, and this diagram is fixed cost. What about my total variable cost? Oh, sorry, total cost. Total cost is what? Total variable cost plus fixed cost, correct? So my total variable cost would be, when I produce 0 unit, total variable cost will be 0. But my fixed cost will be 40,000, correct? So my total cost will start from here. On the financial, right? And if I produce 12,000 unit, what would be my total cost? Total variable cost will be 12,000 times 6 plus 40. Correct? Is that right? Yeah. How much? 72 plus 40, 112. So that is somewhere here. And you see this point, this diagram is known as total cost diagram. This is a fixed cost, this is revenue. But what do you understand by this point? That is the point when total revenue is equal to total cost, and that is this situation, and over here it should be 100k. This is the break-even analysis diagram. Although I have written not with the correct measurement, but if you really draw with the correct measurement, this diagram will appear perfect. Understand me? So this is one interpretation of your break-even analysis. Here we have certain additional reading, which are, you see, I have a gap here, correct? My minimum production is how many units? But how much I am producing? Oh, say, minimum sales. My minimum sales 10,000, but how much I am selling? 12. So I have a gap of how much? 2000. This gap is known as margin of safety. And here again, in order to break even, how much I should generate revenue? 100. But how much I am generating? 120. So there is a gap again, and this gap is also known as margin of safety. But this one in quantity and this one in dollars. Understand me? So how comfort you in your business as of now? How you find out? Your current product sales units and the break even, say the difference is what the comfort level. If you increase this, better. If it decreases, you are enforced or encountering dangers. Is that understood? So on the other hand here, your revenue. So this you can also calculate. We say that given sales, in this example 12,000 minus break even sales will give you margin of safety. Margin of safety in dollars, same given sales minus break even sales, but this should be in dollars. Or otherwise, you see the answer for this how much? 2000, right? Times your selling price will give you this answer. So margin of safety in quantity times selling price will give you what? Margin of safety in revenue. Is that clear? So we will try one example. Yeah, this one anyway they have done it here, but this is one simple example. Already they are in your answer. Cost benefit analysis is little more than break even. Is a systematic process of comparing the benefit of a decision or investment with the cost involved. It helps business evaluate whether a project or decision is worth pursuing. Always I need my net benefit to be plus. If my net benefit is minus, then no use of engaging into this. Now this is one typical example that is given there. A company is considering investing 100,000 in a new machine that will save 25,000 per year for next 6 years. In this example, I want to tell you one thing. You see here, how many years? 6 years. And it was a simple mathematics they have done. Actually, it should not be like this. Now, why I am saying, if you go here, do you understand the meaning of this year 0? Year 0 is when? Year 0 means right now, just now. Year 1 means after 12 months. So accordingly, year 2, year 3 will go. Now my question, any given value at year 0 and at year 1, is it same?
No.
It's not same. Reason is what? Why you say that it is not same? Inflation or depreciation is not the right term though. The correct term is inflation, or there is another term, cost of capital. Cost of capital. Because of that, your value will change. But in this example, what they have done here, they have ignored that principle. They just multiplied by 6. But it is not the case. The $25,000 for reals you will receive now and 25,000 reals you will receive after 3 years is not the same. But in ignoring the cost of capital principle, it's a simple mathematics. So accordingly, your benefit is 150, your investment is 100. Obviously, you are much benefiting. But if you really work out and find out with incorporating the cost of capital concept, maybe your decision might be wrong. So I just wanted to highlight that. So we have to find out all, quantify all cost, identify and quantify all benefits, and it's a simple mathematics. List down all your cost, list down all your benefits, and then get the totals and then compare. And that is very important to have a decision in order to see whether any activity that I am engaging is giving me such benefits. What's the time now? 12. Now that madam has come and told me by 12 lunch will be ready. So after this we will involve into the major topics, inventory, property, plant and equipment, and investment property. Thank you so much. We will manage using IAS 16. Any standard, when you read any standard, there is a pattern of reading it. First is, you need to understand what the objective of reading this, or what the objective of this standard is. This standard is to prescribe accounting rules for PPP. What are the required accounting rules within property, plant and equipment? We will discuss under IAS 16. So that is objective. Next, scope. Scope meaning coverage. So if you look into here, asset has a big scope here. I have current assets and I also have long-term investments, intangible investment and property, plant and equipment. This standard will specify saying that all tangible non-current assets will be included under PPP. The accounting rules or discuss that we are going to discuss here, we are not going to address any of these other items. One good example, do you know what the meaning of this? Biological assets. Back in our countries, how many of us have plantation? Coconut trees, rubber estate, even small, 1 acre. Yes?
Kerala.
That Kerala guy has? Okay, we'll go to him later. So, there is separate. Now, if you really look into the land, will fall under PP. But the harvest that you are growing is nothing to do with your property, plant and equipment. That has a different character under the terminology of biological assets. We have immature plants and we also have matured plants. Likewise, there are so many other discussions it may come into. So this is excluded from the topic of IAS 60 or property, plant and equipment. So now we understood what you. So second element in the standard is scope. The third element would be definition. Any standard will set certain definition to understand. First definition, we need to understand what is PPE. How you identify and name. How I define? For you to say this is my PPE, that should be tangible, and that should generate economic benefits, and this should last for a period exceeding . If you satisfy all of these conditions, then you name that as property, plant and equipment. So this is one of the definition. The second definition would be cost. It is important for us to understand exactly how much that particular PPE costing us. So for example, again we talk about this table. How much was it? 1,500. So this 1,500 is the cost. What could be the elements of those? Right? What could be the elements of this? Now, how I define? Let's say I have one 300. So the total comes to 1,500. That's what I meant. I incurred 1,500. How I define? To have the assets in its workable condition and intended location. For you to ensure that asset is found in Al-Sharif Holding meeting room, and this asset is okay to use, intended location and workable condition. Whatever the amount of money that you need to pay for are part of the cost. So the cost will be furthermore, I can elaborate the cost as to purchase price plus directly attributable cost, meaning insurance, duty, transport, loading, unloading, labor cost maybe sometime because you need to hire a labor to help you with, and whatever the possible all those expenditures. You ask yourself a question: if I don't pay this, can I have my asset in my premises? If the answer is yes, then that is not directly attributable. If the answer is no, then yes, that is directly attributable. Then you take the total, then you might subtract what you subtract now. Discounts, rebates, or net cost. Sometime you import a huge plant from German to Qatar, let's say $200 billion, too much hypothetical. The government looking into this. Government understands that you are bringing this machine to do some production or activity that will boost the economic condition of the country. So the government says, my friend, we will not ask you to pay duty. We will waive off the duty. So that type of waiving off, we name it rebates. Also supplier will give you discount, or sometimes subsidies also, government may fund you. So after adding and subtracting, this number is what the cost as we defined over there. Clear? So the first definition is property, plant and equipment. Second definition is cost. We keep on going. Depreciable assets. We know what are assets. We talked about it. And then I will categorize this asset into a different categorization, not like before. Those assets which are depreciable, meaning these assets will have a limited life. So there will be other assets which are non-depreciable. One famous and good example that I remember for non-depreciable asset is land. But actually it should be freehold land. Why? In Qatar we have this land used to do extraction. After finishing the mineral extracts, the land value become almost zero. So this is one example for non-depreciable. All other assets, we have limited life. Building, motor vehicle, plant, machinery, any assets you name it. So we have to understand what you mean by depreciable assets, whose lifetime is limited. Understood? So this is the next definition related to depreciable assets. Next one, scrap value. What do you think? What do you mean by scrap value?
Second sale.
Pardon?
Second sale.
Second sale or second hand sale. Any other interpretation? What is scrap value?
Once it's used, then
The
not
loss,
usable.
the loss on value of saving.
Loss in value in selling. Let's say we'll talk about a motor vehicle. I have a car, brand new price is 82,000 reals. I can use this car for normally, peacefully for 5 years. End of the 5th year, no point of keeping this car. Then I will find someone to buy this at a very nominal price. A nominal price. We will not we will not be willing to do that, but still, if you happen to sell after the end of the useful life a price that is very nominal, maybe let's say 3,000 reals, compared to 82, 3,000 is entirely nominal. So what the meaning of scrap value? A price or proceeds its useful economic lifetime. It could be 12, it could be 18, it could be 15, doesn't matter. But the concept is the money that you can collect by selling that assets entirely after complete use of allocated lifetime. No, it's not fixed. It depends on the management. Now, see, I buy a car, I may say that I will use the car for 20 years. You buy a car, you will say that only 3 years.
From accounting point of view, in the books,
Yes.
is it fixed?
No.
There is rules.
No, from accounting point of view, arriving this number is not fixed, or it can't be fixed. It should be something called management policy. There is no standard to tell me, look, motor vehicle, Toyota 2022 make it to 15 years. No equation like this.
Manufacturer cannot give us.
That manufacturer is a standard, they will come up with SOP. If the manufacturer is telling you, my friend, you are, then you have to take that only. That comes with the certain plant. Now, I used to work in Qatar Electric Water Company. In that, we had power plants in Ras Abu Funtas. In Ras Abu Funtas, there was one power plant, I still remember, power plant A. The lifetime is 25 years. So that was decided by that, there is an entity called ABB. They have said, look, that is, they never said verbally, through SOP, standard operating procedure, they said that the maximum life of this asset is 25. So you got to think in that line. But in general circumstances, like this share or motor vehicle or building normally the people take 50 years or sometimes 100 years. But yet again, that's entirely, that is a management call.
So there is nothing fixed to the IT of the computers.
Computers has another argument. You see, if you buy a computer, normally our best advice for computer, maximum you should keep 2 years. Why? Technology keep changes.
No, it's not for the books, writing it off, depreciation.
Yeah, that's what I'm saying.
For cars, depreciation for cars, it's for 5 years.
5 years.
For computer? See, if someone is keeping 5 years for computer, I will not go and dispute and argue.
For cars.
For vehicles. Yeah, that's no 20%. So motor vehicle 20%.
Yeah, that's a standard, or this is that we can decide.
That's what I'm saying. There's no standard as such. You will not find any book finding saying that motor vehicle should be 5 years. No. But based on the management experience and the history and the judgmental knowledge, they come up with this.
Because after 5 years, after using 5 years, the service cost will increase.
Exactly.
Service cost,
You may have to, every day you have to push the car before you start.
everything is having some running hours.
Yes,
So in 5 years, you will finish the running hours.
correct.
So after but then you have to do a
Hmm.
major modification.
Yes, true.
And go through 2 years.
So there is something called what is that? Overhaul. You need to go for overhaul, major overhaul after utilizing that given operating hours.
Maintenance policy.
So therefore, this comes from management unless any plant have their own SOPs. From accounting point of view, I don't see any specific condition to say that you should follow like this. So we talk about scrap value. What is scrap value? The nominal price that they will receive after completing the given useful, this 5 years useful economic lifetime. So that is scrap value. Then we talked about depreciable asset, we talked about scrap value. Now we discuss something called depreciable amount. What is depreciable amount? For all of those depreciable assets, the depreciable amount is equal to cost minus scrap value. The difference between the cost and scrap value is depreciable amount. Let's say my cost of that car 82,000, scrap value for the sake of example 12,000. So how much is my depreciable amount? 70. So this is the next term. The fourth term, I don't know whether it is fourth. Next one is useful economic lifetime. Number of years these assets will be produce economic benefits or without any interruptions. Within that time, the assets will be smoothly utilized. After then, as you all said, maintenance, additional repair, overhaul, everything might be required. So this period is what these 5 years are. So now we understood depreciable cost, we understood depreciable asset, we understood scrap value, we understood. Then we also understood depreciable amount. Then we understood useful economic lifetime. Now one of the important term that everyone need to know is
Advantage.
can I?
Plus.
Technology help me, thank you. So I was asking earlier, can I browse this? Right. So we can save this entire note. Depreciation. Depreciation is systematic allocation of depreciable amount of depreciable assets over its useful economic lifetime. If you see here, we have too many different terms: depreciable amount, depreciable asset, useful economic lifetime. Now we already discussed those. If we are not discussed, then it will be then we have to try to understand. So now, what is depreciation? Let's say I have this 120,000 is my cost, and scrap value 20, 5 years. So Year 1, 2, 3, 4 and 5. What do you think, how much every year the depreciation will be?
5 to 10%.
I didn't understand.
5 to 10%.
No. 5 years,
45 cents.
45,000?
Yes.
How you got 45,000? 20. 120 is my cost. Scrap fellow 20. Divide this by 5. So that's my depreciation. And you understand, you see that every year my depreciation is 20. In other words, every year my depreciation is same. Should that be a condition? Where you choose the method of depreciation, there is something called method of depreciation. There are two methods which we need to discuss. One is straight line method. Other one is reducing balance method. Now we will try to understand straight line method. Straight line method says what? Every year depreciation should be same. Now, same example I used, 120, 20, so 100, 5 years, therefore depreciation per year 20. How much is the percentage?
20%.
Depreciation percentage 20%. How I calculated? 100,000. What's that? Divide by 5 is equal to 20%. Correct?
Correct.
Or 20,000 divided by 100,000 into 100. So which is equal. If I to draw one diagram to find out the way the asset value is reducing using straight line method, and this is the cost, this is the lifetime, and here 120 and here 20, here 1 and here 5, it go like this. So this is what you call straight line method. Second method is reduce imbalance method. In reduce imbalance method, same example I will use. The cost 120, scrap value 20. Instead of the lifetime, they will give you depreciation rate. So now I will calculate year 1, 120 times 35%. You should note the difference. I have not subtracted this. I have taken straight away from the cost. So year 1 how much? Can someone help me please? How much? 42,000? That's the first year. When you go to year 2, what you do is that you take 120 and then you subtract 2 and then you multiply this by how much you get then?
27.
Can you see that first year depreciation is larger, second year depreciation is smaller. So, and also the here 120 I have 120 by 80, 78, right?
Yes.
And if you go to the next year, you also mathematically understand this answer will be even smaller. So accordingly, if I to draw a graph, let's go like this. It will not be a straight line. It will be a curve, downward sloping diagram. So that's the difference between straight line and reduce imbalance method. Now we move on to, I'll go back to that 1 second. Meaning at the end of the use of that given years, at what price you can easily find in the market.
Here, I consider 5 years.
Yeah, the life will be 5 years only.
This correct time.
Exactly. Although I stopped at 2 years, you will continue up to 5 years.
It's not predefined. It's not like
Pardon?
the scrap value is not like what when having the scrap value is.
See here.
No, it's just a very small, example I have taken. Normally scope will be very small number.
Okay, here the scrap value, it will be calculated after the lifetime finish.
After 5 years.
5 years.
No, you estimate.
It's a market.
No, you make an estimate. You will not wait until 5 years.
Either 55% or I have the scrap value. Another book.
I don't understand what you're saying.
Either
My net, see this answer. This answer should be how much? 20, right?
Okay, yes.
So end of the 5th year. So end of 4th year we will know how much is, let's say for example, end of 4th year, my net book value is for example 35. Correct? This arrived based on the calculation. But in the 5th year we will not do any calculation. 35 minus 20 and my depreciation will be 15. You will match that scrap value in the last year. Yes, that's what you will do. So we then have to think about double entry. Mr. Luca, who is that guy? Luca Paciole. So what he has said. Now we need to know the debits and credits. So for depreciation is an expense. Before I come to that, I will just give you a small table, rule for double entry. I have debit, increase, decrease, increase, decrease. If I have one asset and if that asset will increase, I should debit. If the same asset, if that decrease, I should credit. So that is the rule for asset. Now liability. If I have liability and that is increase, I should credit. If the same liability decreases, I should debit. That is for liabilities. Then income. So income, if my income is increasing, that also should be credited. So here I have debit, credit, increase, decrease, increase, decrease. So income, increase, I should credit. What about expense? Increase, I should debit. Decrease, I should credit. Same thing, income, decrease, I should debit. Last one, capital. Increase, I should credit. Decrease, I should debit. So you have to have this table. In depreciation, we should understand that depreciation is what? Is an expense. And expense, increase, I should debit. So depreciation, expense, I debit. Now the issue is we have to credit. Normally, accounting principle says that you don't subtract this value from the cost of the asset. Now from that example, 120,000 was my cost, first year depreciation was 20,000. Now end of the year, how much is my value of the cost asset? The cost was 120 and depreciation how much? 20. So the value becomes 100. But in books what we do, we never change the cost. We keep the cost as it is and we show this separately. The thing that we show separately, we name it as accumulated depreciation. That looks like, same like capital and equity, it's a provision. So I credit to that. So this is the double entry for depreciation expense. Is that clear, all of you? Any doubts or any questions before I move on?
The depreciation is determined by who? There is no specific.
Management. We just discussed about this.
From the markets also.
Yeah, see, management will decide based on the judgmental experience, market knowledge, the SOPs, various factors. Now, okay, if I give you one example, you have a vehicle, you lease it. You take a leased vehicle, a motor vehicle. Assume this motor vehicle we just discussed, it should last for how many years? 5 years. But the leasing company said you need to repay the lease within 4 years. In this situation, you cannot depreciate the asset with 5 years. You should depreciate on 4 years. Makes clear? So that is what the difference is. So it is again, it's a management call. So we talked about depreciation for depreciation expense, and then next one would be how will you show in the financial statement presentation. Now after completing your accounting, we need to prepare a financial statement which we need to include the asset side also. So you will you will show it in your balance sheet, you will show the cost. In that example, my cost is 120, my accumulated depreciation how much? 20. So net book value, this is how you will show it in your balance sheet. Now what about the P&L, meaning profit and loss account? There under expense heading, you will have one expense called depreciation expense and the amount is 20,000. This is the very basic step in the property, plant and equipment. Next we talk about some new terms. We talked about this already. we need to discuss 1, 2, 3. Any idea about this term? How you can define fair value? Or what do you think fair value is? Okay, look into this example. Mr. A has a very beautiful car with the wheel alignment also. I mean, what that wheel? Alloy wheel. So now this man want to sell this car. There are two potential buyers. B and C. B is the brother for A and cider. Now, if Mr. A want to sell the car to B, he might agree a given price. Let's say Qatari Riyal X. Same, if he want to sell to Mr. A, C, he will agree Qatari Riyal Y. Will this X and Y be same? And will that be the difference? Could be significantly huge or slightly marginal? Could be?
Depends on the relationship.
Yeah, exactly. Sometimes he will charge more. Yes, sometimes he will charge more than the outsider. Go to hell. See, what the fair value is. Now, do you know the meaning of the word arm's length? Now, if someone walks on the road and you see them, either a male or female, is there any limitation for you to take them within this radius? Can you take everyone within the radius? I mean, can you hug everyone? No, you can't do that. You have certain limited people whom you will see on the road. So, a group that you are allowed to entertain beyond the arm's length are your close people, husband, wife, mother, father, children and siblings, and to some extent friends. So, their group is different to others. So, when you going to arrive a price which at I'm going to set a price for a person whom you will not allow him to move within this border. You keep him outside. At any moment, a price that you're going to designate when he is not allowed to cross the border, number one. Number two, knowledgeable, meaning this car, the total in and out information about the car, both the buyer and the seller should know. That's why we take the car to computer test, because we don't know how many bend in the chassis. So the seller is very much silent until he find the buyer. So first thing is knowledgeable. Second point is willing. Knowledgeable, willing. There no one is under the influence of the gun, keeping the gun on the forehead. You must buy, otherwise I will kill you. No such condition. It is such that the buyer and the seller, both parties are willing to engage into this transaction. So number one. Number two, knowledgeable, willing parties when at an arm's length. The price that you will arrive for knowledgeable, willing parties at an arm's length, that price is what I mean.
Practically, seller and a buyer needs to agree on the
Correct.
price. And this is
So, if other way of arriving prices are not fair value, it is very important. Yes, you have a question? It is very important that to establish the fair value, then you will understand the transaction that I am engaging, am I making a profit or a loss? So that is fair value. Next is actually carrying amount. Very simple. Cost minus accumulated depreciation. Now what is accumulated depreciation? Year 1 my depreciation 20, year 2 my depreciation 20. At the end of the second year, what do you think my accumulated depreciation is? 40. You should understand that. The total of the depreciation so far to the end of whatever the number of years. So that is my accumulated depreciation. Accordingly, carrying amount is equal to cost minus accumulated depreciation. Then one last terminology over there. Impairment. What is impairment? Now, many of us have experienced tsunami. I don't know whether it is a comedy or a real story. This weather forecast department has informed the government. They talk about Sri Lankan government, that tsunami is arriving. Somebody, what they did, they went with the placard of tsunami and then waited outside the airport. Welcome, Mr. Tsunami. Because this is like, it sounds like a Japanese name. So anyhow, when tsunami affected, there has been lot of natural disasters. Now we make a building, we believe the building to last 50 years, but because of the tsunami or because of the earthquake, building collapse after 5 years. So any damages taking place prior to our but we mean unforeseen impact of damages. Unforeseen impact of damages are known as impairment. Oh yeah, exactly. That's why we put that terms in the contract. So this is impairment. Their personal purpose. So that's why they say it could be a land. You keep a land for the purpose of investment to generate additional capital gain. Do you know the meaning of the term capital gain? To generate additional capital gain, you keep a land, or you have a building for the same purpose, or you sometimes lease out. You generate rental income, or part of a building, or both, meaning land and building. For what purpose? Held by whom? By the owner, or the lessee under a finance lease. When you talk about leases, there are two types of lease. One, we have finance lease, other one we have Operating lease. What is operating lease? Nothing but simple, like rent a car company. You go to Al Mufta rent a car, you take the car, you use it for 15 days, 1 month, 6 months, whatever it is, you simply only pay the rent agreed by them. Insurance, maintenance, they will do. So that is operating lease. But also same story with your renting your property. Your tenant, they will only simply pay the rent. But you know, one to this standard. Now this what I am talking about, the previous standard. But the new standard is IFRS 16, that has so much of additional things I deliberately do not want to discuss. There what they are saying is, according to this, your tenant will claim ownership of part of your property. Don't get upset. There is something called we'll ask now. Right of use asset. There is something called right of use asset. You are not the owner. You are not purchased the property. Simply you rented. You are occupying it. And because you are occupying it, you in your books, you will classify some of the asset category as right of use asset. So anyway, this method of classification is the previous standard. So there I have this finance lease. Now you know who are these people? Lessor and lessee. Who is lessee? The person who has taken the property. Who is lessor? The owner of the property. So if you go to this now, held by the owner or by the lessee under a finance lease to earn rentals or for capital appreciation or both, rather than for. You could have it this for what purpose? To earn rental. To have a capital appreciation or for both purposes rather than this one. What is this actually? Nothing but property, plant and equipment. Used in the production or supply of goods or services or for administrative purposes. Like furniture, like equipments, like building, like factory, or sale in the ordinary course of the business. This is inventory. So that is what the definition of investment property. Owner occupied property. What do you think owner occupied property means? The word itself says it is occupied by the owner. So those property occupied by the owner cannot be expected to have rental income, or it cannot be expected to have capital appreciation. It is just simply like a normal property, plant and equipment. Therefore, you need to use it and depreciate it. Carrying amount, I don't need to repeat again. Fair value, I talked about it. Impairment also, I discussed it. The same as that. Classification of property as investment property or owner occupied property. How I know this property is investment property or this property is owner occupied property? Land held for long term capital than for short term sale in the ordinary course of the business. I am keeping a land for next 20 years. Let the price increase. Then that becomes investment property. Land held for a currently undermined future use. I have this land and the possible future use is currently undermined. That is also what you call investment property. A building owned by the entity or held by the entity under a finance lease and leased out under one or more operating leases. Again, investment property. A building that is vacant but is held to be leased out under one or more operating leases. It is empty, it's not occupied, but you will lease it out for tenants. Property that is being constructed or developed for future use as investment property. All of these are investment property. Believe your category, your example. Think, relate to your business property now. Is it falling into any of these discussing point?
Yes.
Correct, right? So just relate to that. Now, which are not in a business or in the process of construction or development for such sale, which is IAS 2 inventory. Actually, in real estate, once the building is available, you have the building to sell or buy and sell in the ordinary course of the business. You are not keeping the property for another 20 years to sell. You are on a rotation, on a routine basis. If you are keep selling this property, and that become IAS 2 inventory. Secondly, owner occupied property, which you need to use IAS 16. Normally you need to depreciate. Property that is leased to another entity under a finance lease. Now you have leased to somebody under a finance lease, then that also owner occupied property or should be treated as IAS 16. How I recognize? So as I told you, investment property also should be recognized as an asset when and only when these two simple conditions: probable that the future economic benefits that are associated with the investment property will flow to the entity. Number one, I should receive economic benefit. I must receive rent. If I don't receive rent, no use of that. I don't know, you all remember on the Cornage, there was one building constructed and suddenly a fire came. Fire broke out. Remember, right? Al-Habtor is not completed. That is an investment from Dubai. I am talking about another property. One suddenly the maybe 10 or 15 floor got fire, and then after that they certain period of time. So if you don't have the confirmation or a guarantee that it is going to bring economic benefits for the on entity in the future, then you cannot recognize that as investment property. Cost of the investment property can be measured reliably, not vague, precise, bizapt. You should be able to arrive the cost reliably. So, investment property shall be at its cost. First, you need to measure the investment property at cost. Transaction cost shall be included in the initial measurement. What are element of cost? We discussed about it. Purchase price, directly attributable expenditure, for example, professional fees for legal services, property transfer taxes and other transaction cost. Then, startup cost, unless they are necessary to bring the property to the condition. See, the cost of investment property is not increased by startup cost. Startup cost will not increase unless necessary to bring the property to the condition necessary for it to be capable of operating in the manner intended by management. Operating losses, no, you will never take it as part of cost of investment property. Abnormal amounts of wasted material, labor or other resources incurred in constructing or developing the property. These three examples are not part of investment property. Measurement after recognition. An entity shall choose either fair value model. I'll go back, wait. You expect you to have 500 hours of labor normally during the construction. But suddenly you had to have 700 hours of labor for some strike or some additional deadline. Prolongation is not the only condition. Again, prolongation also beyond the plan, yes.
Prolongation not in the plan for 2 years, they extend it for another year.
Another, you mean another 3 years, total 5 years.
No, the construction.
Yes,
The target was to complete the project in 2 years.
correct.
Due to a lot of things, but delay. For another-
So yeah, that cannot be capitalized. That needed to be recognized as expense.
In case I'm paying more,
Yeah, that's what I'm saying.
so the variation for the construction.
If you can agree that with your contractor, it's a different story. Now you will have your own construction. Now the question is whether are you the construction team or you are a contractee, who you are, contractor or contractor. You are the owner, so you hire a contractor.
For 1 million,
Correct.
they extended for 2 years.
Hmm.
They extended for another year.
Yeah, now he extended for another year. So that extra 1 year is now due. So which needed to be material, labor and everything needed to be incurred.
But it will be carried by the-
Now the question is whether it should be capitalized or not. This is the question. Depending on how the outcome of the variation.
At the end, the construction cost is 1.5 million.
Correct.
Ended up like that.
Hmm.
And the building,
According to the 2 years.
the contract, so instead of 2 years, the
See,
instead of 1 year, it's 1.5 million.
yeah, 1 point out of 1.5. What do you think? Why they are keeping this? What is the business?
Avoid the sunlight.
To avoid the sunlight. Okay, for the people inside. What about the people outside? Yeah, they to refrain people from outside seeing the reality inside. Maybe reality is beautiful, or sometimes reality is very, ugly. So, from business jargon, the word meaning window dressing is to show a rosy picture to the shareholders or the owners. So, if the operating losses are due to inefficiency of the management, and if you just justify that this is not part of my problem, this is due to the not readiness of the property, I am going to increase the cost of investment, the property, which is not acceptable. So that's what we try to elaborate on that. Hope I made it clear. Yes.
This abnormal amount of wastage is like during the construction.
Yes.
Sometimes we do some rework.
Hmm.
So this also we can.
Yeah, that is one example. Yes.
Finally, we need to present the final product. So during the construction, we will wait,
Hmm.
and again we need to do. So this has.
This is one example of wasted material.
And who decides about this?
Management.
That okay, any work that you'll do that will create economic benefit and be consumed within 1 year,
Yes.
and they reduce the operating expense, this can be capitalized.
Yes, true.
So this is a bit contradictory.
Contradicting? I will go back.
Something to reduce the operating cost. This will be capitalized. But meanwhile, that's part of the operating cost.
See, operating losses incurred before the investment property achieves the planned level of occupancy, which cannot be part of the capex. If that operating loss, what we are saying, if that meets what you telling me now, if that is reducing the expenses and so on, argument is different. But here it is not that. When you say operating losses, what is the word loss? Forget the operating.
Say operating cost is, let's say this is the salary for full staff, although I have 10% of this or 90%, I have full staff on board. I cannot consider this as operating cost.
Now, if that salary only, now what is loss? Word loss means sales minus expense. Correct? You have a zero sales and you keep on incurring some expenses, like coming to your example, salary you keep on paying to somebody, they are sleeping and waiting. They are not generating any efficient outcome, and due to you have hired them, you have no choice but to pay the salary, then that becomes operating loss. Understood? So we have two models. One is fair value model. What is fair value model? Every year or regularly, you have to carry out. Let's make pen. The cost $100. At the end of the first year, my asset value, the difference between these two is 10. Same thing I talked about under IAS 16 revaluation, but only difference is how you deal with this. In IAS 16 we talked about a lot of complication, first revaluation, subsequent revaluation, like this. Here nothing at all. So how much is the difference? 10,000. You take straight away to profit and loss account. Now next year you come up with 105. So there is a loss of how much? Then do you need to worry about previous value? No, nothing. So that 5,000 you take it to P&L as loss. So this is what the fair value model is. And every time the value also will change. End of the first year 110, end of the second year 105. You will show it in your balance sheet like that. After initial recognition, an entity chooses the fair value model shall measure all of its investment property at fair value. A gain or loss arising from change in the fair value of investment property shall be recognized where in profit or loss for the period in which it arises.
The meaning of fair value
Yes.
is the same in this context as well, because we discussed what is fair value.
Same, no difference. If an entity previously measured at investment property at fair value, it shall continue to measure the property at fair value until disposal. You cannot change the method. Now we discussed two methods, fair value method and cost method. Now the first time you decided to use the valuation fair value treatment, subsequent years also it should be fair value. Till the property becomes owner occupied property or the entity begins to develop the property for the subsequent sale in the ordinary course of the business. Even if comparable market transactions become less frequent or market prices become less readily available. Forget about the huge sentence. Simple story is, once you stick to fair value model, in the subsequent years also you should stick to fair value model unless you sell the property or you become occupying the property. That much if you understand, enough. Cost model is simple. After initial recognition, an entity chooses the cost model shall measure all of its investment property in accordance with IAS 16, which we discussed. The requirements for that model, other than those that meet the criteria of IFRS 5, don't worry about this. That is another world. So which is we will not discuss about. Okay, what they are saying, transfer between cost model and fair value model. Transfer to or from investment property, it is between investment property and other properties, shall be made when and only when there is a change in use evidenced by commencement of own occupation. If the investment property, the owner goes and start occupying, no more investment property. That will become own occupied property and you should treat using IAS 16 as a property, plant and equipment. End of own occupation for transfer from owner occupied. See, this is the other way around. Owner was occupying somewhere, he moved, then that will become investment property. Commencement of an operating lease to another party for a transfer from inventories to investment property. If that property you were keeping it for the purpose of selling, but now what you do, you are given on lease. Then from inventory, it will be transferred to investment property. For a transfer of from investment property carried at fair value to owner occupied property or inventories, the properties deemed cost for subsequent accounting in accordance with IAS 16 or IAS 2 shall be its fair value at the date of change. What do you mean by this? What they are saying is, what is the amount that I should be taking it? The amount that I should consider is the fair value at the date of the change, and that we should deal with IAS 16 or IAS 2. IAS 16 is what? Property, plant and equipment, and IAS 2 is inventory. When your investment property is getting transferred to either one of these two, the fair value you will take accordingly. If an owner occupied property becomes an investment property, that will be carried at fair value, and entity shall apply IAS 16 up to the date of the change. You understood this? What they are saying? See, I have now here it is owner occupied property, and here it is investment property. Now during this time I will be applying IAS 16. From here onwards I need to apply IAS, and here I will be using cost minus accumulated depreciation. Here I will use fair value model. Vice versa also same. Yeah, that's what they are explaining. The entity shall treat any difference at the date between the carrying amount of the property in accordance with 16 and its fair value in the same way as a revaluation in accordance with IAS 16. You see, I need to do a change here, correct? And any difference coming here, I should treat as revaluation surplus. That's what they are saying. For a transfer from inventories to investment property, that will be carried at fair value. Any difference, I should take it to profit or loss account. Investment property shall be de-recognized. We can sell. Like we can sell the property, plant and equipment, I can also sell the investment property. They eliminated from the statement of financial position on disposal, or when the investment property is permanently withdrawn. Sometime one of the property completely damaged due to natural disaster. So then you need to remove permanently. Withdrawn from use and no future economic benefits are expected from its disposal. Gain or loss arising from the retirement or disposal should be taken to profit and loss account. Compensation from the third parties for investment property that was impaired, lost or given up shall be recognized in profit or loss when the compensation becomes receivable. You understand this? If the third party, some third parties act, then you can claim from them, and that you can consider as compensation receivable as an income, and also factor or relate this with insurance. So that is what they are saying there. An entity shall disclose whether it applies the fair value model or the cost model, the amounts recognized in profit or loss, net gain or loss from fair value adjustments, transfer to and from investment property, the depreciation method and the useful life. And this concludes the discussion of investment property. Any other question before I move to the last topic, inventories? Or what's the time now? 3. We'll take a small break and then we'll continue with inventory. Welcome, sir.
Hi, how are you? Hi, good afternoon, everyone.
Good afternoon.
Good to see you again. So good to see you again.
No, we kept 2 seats for you. You can choose anyone you like to.
Thank you, sir.
International Accounting Standards number 2, inventory. Now, to understand, just let's try to get some basics of our accounting. We have sales, let's say 1000, and I have my cost of goods sold, let's say 600. So the answer is gross profit, and that is 400, and expenses 200. A very healthy company made a 200 million net profit. 200 real also possible. So now we need to deal with this segment, cost of goods sold. We need to find out an equation for this. Cost of goods sold is equal to OS, means opening stock or beginning inventory, plus purchases minus closing stock. This is the internationally used cost of goods sold. Sometimes people say cost of sales. Scenario number 1, I have my opening stock 0 and my closing stock also 0, meaning there is no inventory involved in this business.
I produced, I sold.
Yeah, exactly. What I produced or what I purchased, I sold. This is the scenario number 1. In that case, you see my cost of goods sold is equal to 0 plus 600 minus 0. So my answer is 600. Our life is very easy. Straightforward scenario. And what is the interpretation of the word cost of goods sold? How I interpret this? In order to generate sales of 1000, I had to incur a cost of 600. If I try to keep it even simpler, I have to buy, let's say, packet of rice, kilogram, don't ask me the kilo, maybe 50, 100 or 5, whatever. The packet of rice, my cost is 600, and the same packet of rice, this is the cost. Selling price of this is 1000. That's the simplicity that we are replicating in this statement. Very good. If I move to a different scenario, our normal business circumstances is such that, now let's say my calendar year, this is 31st December, I have purchased during this year 600 $600 worth of goods. Practically, we cannot anticipate that to sell this entire 600 during this time frame. Is that possible? Is there any written guarantee that you will be able to, you are quite capable of completely selling everything by 31st December 11:59 PM? Possible? Not at all possible, correct? So there will be certain amount of items remaining. So on this date I will have leftovers, correct? Now the other point is, these leftovers are either in good condition or in a bad condition. If it's in good condition, no problem. What you can do, you can carry forward this to next year. You can carry forward such amount of good in good condition inventory I can use and sell it to my customer in the next year. Whereas bad in shape, I cannot do anything. Now sometime again it is also depending on to the extent, the which extent the condition is bad. Sometimes it can be 100%. You can do nothing but to throw it away. But on the other hand, you could find buyers from Najma. This this is scrap market. You could generate possible meager income from selling them. So it could end up having, we name it, there are different names: obsolete, slow moving, idle, or also damage. These are the possibilities. Now you see, think about a textile shop. Just before the festival season, any Ramadan, for example, Ramadan festival, during Ramadan time, last 15 days of the time, every textile shop, they will dump with fully fashioned new arrivals, and there are so many names. After the festival over, within the next 3 months, they will, up to the next 3 months, they will somehow try to sell this. But then many remainders will be left over. These leftover, we could name it as obsolete, or obsolete actually, not slow moving. These, especially the female wear is the issue. There are so many different captions. Sorry. When you talk about the shalwar, again there are 200 different varieties. And then some are highly fashionable, they will still be willing to, still they are good condition, but they don't want to buy. So the shopkeeper unable to sell this. Then that needed to be categorized under this. What do you mean by slow moving or idle? Spare part shop. Think about a spare part shop. There are certain spare parts sitting there for last 5 years, for last 8 years. I still remember I used to perform inventory count audit at Qatar Electricity and Water Company. That is the power generating business. They had their warehouse or the stores. Millions and millions of riyals worth of items are purchased and peacefully sleeping in the warehouse only. It is not been utilized. According to the prudence concept. What is prudence concept?
In case of something happens, you have the stock.
In case of something happens?
Yeah, you have already the stock. You can't tackle it.
No. That's not the prudence. In general, from an English point of, forget the accounting. From a general English point of view, what do you mean by prudence? Being a prudent person.
Careful.
Okay, I'll give an example here. I have a bus halt, and this girl waiting in the bus halt, 10 p.m. on the road, there's a chance that now one bus is coming. This is the last bus.
You come 10 minutes before.
Pardon?
10 minutes before.
She can jump to the.
No, now the situation is that she is waiting there 10 p.m. So I'm not developing a different scenario. So answer my question on these circumstances. So let me complete. It's still the story not finished.
Prudence concept, she needs to come earlier.
Yeah, that is one prudence. Now the situation is different. She is here, 10 p.m. Bus is coming, and this is the last bus. Behind this bus, there's one car also coming. A very close gap. She can see that possibly this car is her father's car. Now, being a prudent girl or a prudent person, what should be her decision? Remember, this is the last bus. And I will write bus, otherwise you will not know whether this is a bus.
The decision to call the father if he's there.
Mobile is not there.
Take the bus.
Take the bus. So this is a normal interpretation of a being prudent. Now we will relate this to accounting. There's a concept called prudence concept. What the prudence concept is saying that you should never allow to overstate your profits. And on the other hand, you also never allow to understate your losses. Now, say for example, you have joined a company, and in that company, normal custom, you are a new employee. Normal custom is that every month, first month, he has to give a party from his first month salary. So, he has to understand that on the basis of the customary practice in the company, end of this month, I have to set up a budget for the party. So, this amount of money should be separated to be ready for such loss. I will reverse the scenario. If someone promised him, my friend, 15th of next month, I will give you 10,000 reals. He is very happy. What he is doing is now 10,000 he is sure, damn sure he is going to reach, because one of the reliable person told this. So he started borrowing 500 from somebody, 1,000 from somebody, and then he started enjoying his life until the 14th of the next month. On the 14th, he is receiving a phone call. My friend, that person telling, I lost my business or my job. I'm sorry, I can't give you this money. Where he will end up? He will end up in a disaster, correct? So coming back to this example now here, things that are you purchased in good condition, but it is not frequently sold. It is sitting doing nothing. So these cannot be now. Normally, spare parts are part of my assets, but I cannot consider that as asset because of the very nature. So, reversing back to this, normal circumstances, the good condition assets, we can carry forward to next month. So, that means out of 600, let's say 25%, I carry forward to next month. That means how much? 150. Now, go back to the equation. Cost of goods sold is equal to opening stock plus purchases minus closing stock. Now, cost of goods sold, opening stock we know 0 because nothing there. Purchases 600, and how much is my closing stock? 150. Clear? What do you mean by closing stock? The remaining items available in my business on 31st December at 11:59 p.m. So that is my closing stock. So now your cost of sales how much? 450. Accordingly, your income statement, 1000 is your sales, and 450 is your cost of sales, 550 is your gross profit. Previous example, 1000 is your sales, stock 600, sorry, 400. Could you notice a huge leap or significant leap between these two? Meaning that when you have an increase in your closing stock, then your gross profit will also increase. Understand me? So this is the scenario 2. Third scenario. Now, this is 31st December 2022 and this is 31st December 2023. And we know that on this date I have 150 because that was the remainder from the last year. And during this year, I purchased worth of 700. And now, here, remainder 200. How I calculate now? Cost of goods sold is equal to opening stock plus purchases minus closing stock. My opening stock is 150 and my purchases 700 minus closing stock 200. So my cost of sales 650. Clear? So these are the 3 possibilities of we calculating cost of goods sold. Now the question is, from our accounting point of view, how I know which falls into the category of this closing stock or this opening stock? What are the items that I can categorize as to inventory, in other words? How I define? What are my inventories? We know that from our very last week session, we have asset, and that asset categorized into 2 headings. One is current asset, other one is non-current asset. Now we are here not to discuss this now. We want to focus on this. So what is the current asset definition? Those assets should bring economic benefits within 1 year, within a period of 12 months. So it should involve economic benefits for 12 months. When you satisfy that, then that becomes current asset. See, asset we had a definition: past history, control and future economic benefits. With the past history and with the control, the future economic benefits limits to 12 months are part of current asset. Then we have examples. One example is inventory. So now if I reverse the queen, if I go from the bottom to up, what should be inventory? Inventory are assets. Inventory are which assets? Current assets. Inventory are current assets that should bring economic benefits within the 12 months. And I will add some additional condition in the ordinary course of the business. What do you mean by this term? Ordinary course of the business. Abdullah Abdul Ghani motor vehicles. Abdullah Abdul Ghani may have different business. Abdullah Abdul Ghani this Toyota business. And Al Fardan jewelry. So 2 different business. In Abdullah Abdul Ghani, they have motor vehicles. And in Al Fardan jewelry also, they may have motor vehicle. So having a motor vehicle under the books of Abdullah Abdul Ghani is one example of inventory. Why? In the ordinary course of the business, he is keeping the motor vehicle for the purpose of generating economic benefits within 12 months. How? By sale. So one way is that sales. You will sell it. The other way, you don't necessarily need to sell. Think about, just in the morning we talked about Toyota. Now Toyota manufactures car, Toyota also manufactures spare parts. So these spare parts, after they completing the manufacturing, they transfer to assemble the motor vehicle. So they can use in the manufacturing. So they can sell it or they can use it in the manufacturing. However, that should be as part of ordinary course of the business, and that should satisfy all of this. If you fulfill all of these conditions, then you can name that example is an inventory. Another word here actually we have stock. Sometimes we alternatively the accounting standard name IAS 2. Now the objective here is to recognize the cost for the inventory, and when those costs are transferred to income statement as expense. If you understood that, you see from this now on 31st December 2022, I have 150 worth of inventory. Let's assume next year this 150, what will happen, this will be put on to pool. This 150 will be put on to pool during this year to keep it available for sale during that year. So I will convert this inventory as an income. If I convert any inventory as an income, and on this date, this 150 is part of asset. But during this period, this asset will be converted to expense. Why? The 150 is not the income. You are selling that 150 worth of item for maybe 200 or 300. Income will be greater than this. But this 150, you will compare, you will match with that 300 and then arrive the gross profit. You remember, I had sales and I had cost of sales. Then the difference I named as gross profit. And here only 150. That's what they are saying here. If you read here, transfer to the expense. IAS 2 excludes construction work in progress, inventories of financial instruments, biological inventory assets related to agricultural activity and agricultural products at the point of harvest. Now, yarhamakumullah. So, now this construction work in progress is a different ball game altogether. We had a separate standard, meaning in the past tense, IAS 11. But after standard board went on to revise this, they came up with a new standard IFRS 15. That another topic. Plus, they also talk about financial instruments. Like you have investment in the bank, you have taken, there are different terminology. I'm pretty sure you probably have come across. Features, swaps, options, bonds, and so on. Not the James Bond, but the this is a different bond. So these are examples of financial instruments. That financial instruments are financial inventories. We have different standard to talk about. Now what IAS 2 is particular about, inventories on tangible manufacturing items. For example, if you are buying and selling a chair, then this chair will become an example of inventory. If you are buying and selling stationery, then that stationery will become inventory for a normal office like accounting office. But we will have the work in progress hours. I may have spent 20 hours in one client, but still the client is a good guy, didn't pay me yet. So I still keeping that as my cost. So when I invoice to him, when he pay me that, then I will release this 20 hours to my income statement as an expense. Understand me? So that is what here they are defining. So I believe this is clear. What are the objectives? Held for sale in the ordinary course of the business. We just talked about it. In the process of production for such sale. Now, when you say that, we also have another small dimension on this. This is the manufacturing process, and here I have material. This is the process or progress of manufacturing. I have manufactured 0% and I have manufactured 80% and then I have manufactured 100%. If you really watching this line or this progress, and when I bring in my material at this point of time, I would name this as raw material. Understand me? Now you remember we talked about this ball. Now this ball sits here. This is a fully finished, we call it finished good. But the rubber sheet that I used to manufacture or produce this ball at 0% completed. Think about a steel shop, buying and selling retail steel shop or a cement shop. You have a cement shop, they have a warehouse. Okay? First shipment of cement coming from a container. What they do? They will store it here at the last, correct? So likewise, the first shipment they will fill it here. The second shipment will come and fill it here. Now if they are following 5-4, what is the meaning of the full form of this?
First in,
First out. So now a customer, here let's assume 200 bags, here assume 150 bags. One customer is needing of 100 bags. If I to follow this concept, practically what I need to do, I have to come behind the roof or backside of the building or whatever, I need to pull out 100 from this plot. Practically possible? Practically not possible. But for convenience sake, for the sake of calculation and for the assumption, we say that whatever the inventory you received first, you will show first. And what do you mean by this weighted average? Is you don't worry about the sequence of when you received and when you issued. What you do is you put everything into one pool and arrive an average cost. So this is cost. Now, what do you mean by this NR? What's the full form? Net realizable value. That is the full form. Net realizable value. See, future selling price minus estimated completion cost plus this is the NR. Now let's discuss. Now if I go back to that example, now I am here. I have completed a particular inventory at 80%. Now, I want to find out what is my NRV. I still need to complete another 20%. That t-shirt, I don't have the hands and the collar, I have to stitch on. So there are additional costs that I may have to incur, which is known as estimated completion cost. A different example, packing, wrapping, packaging, those type of costs. Plus, estimated selling expenditure. You need to inform the public that you are having this type of material, this type of item. Like when you go to Salva Road, red tag. Every time you purchase one, you get one free. Or 10, 20, 30. The Safari always in the Facebook and you get messages. These are the type of additional expenditure which are normally put it under the caption of marketing. So, I have to incur completion cost and I have to incur expenditure, selling expenses. I get the total of this. Expectation is to have a plus number. That's what you call it, net realizable value. And that value is for the future. You are now where? You are here. You are thinking about when you reach to this point. Understand? Now, IS2 says, you calculate for any given inventory, find out how much is this, decide which one is lower, and then choose that one as well. And then if you ask me how I get this, you have to use either one of these two. Now, here condition lower of, but here any condition like this, there is no condition like this. It is a simple decision by management. It's a management call. They need to decide, okay, I am going to follow FIFO or I am going to follow patent image. This much is clear? Good.
I have a question.
Yes, please.
One scenario, I will make one scenario.
Please.
Practically, we are facing issue.
Great. CapEx. Individual user like you should not be spot on to ask you what is OPEX or CapEx, which you don't know. You are layman in terms of this particular matter. But your organization should have, ideally, I'm assuming, again don't quote my statements as an official recommendation. Then they might come with a huge gun and they might shoot me. So, but in theory, I would expect a team, a committee, a review panel should be there. See, a new item, my understanding, will not come every other day. If you are a normal repeating business, you are not going to buy a mobile phone connecting to, what do you call that mobile? Satellite. Anyway, you are going to buy either Samsung or iPhone or Oppo. So that is normally understood particular item that is available in your business. So they should have that knowledge. So they should review it and they should decide. See, it is, I believe you have ERP, I believe. So this ERP and you are raising PR, not manually. So we talked about the same cost in our IS16. Same thing. You will have your purchase price. Okay, I will put a diagram here. This is the purchase cost, which includes supply price and any insurance, freight, all this. So this box or this rectangle, this relates to my total purchase cost of my inventory. After I receive the inventory, if I had to undergo certain additional process, I then have to hire labor to do some extra work, and that is known as conversion cost. The conversion cost includes wages, wages and overheads. So you had your items, you incurred purchase cost, then you are underwent conversion cost. Now you also sometimes may have direct expenses. What is a good example? We talked about this morning that McDonald's. Talk about a person writes a book. The person who writing a book, we name him author. But all the time author will have the capacity to print? No. The printer will be someone else. So the business for the printer or business for the author? Who will sell the book outside? Printer. But the book is owned by whom? We will have an agreement with the author to pay a certain amount of money per book printed. And that also another name for royalty. So that is one example of direct expenses. So the total of all these are cost of inventory. And this cost you mathematically analyze using FIFO and weighted average. Clear? So we discussed about all of this. Cost of purchase of inventories comprise the purchase price, imports, duties, other taxes, transport, handling and other costs directly attributable to the acquisition of finished goods, materials and services. Trade discounts, rebates and under the previous session. Cost of conversion, directly related to the direct labor, direct material, direct material will not come. Only the direct labor and direct expenses. And systematic allocation of fixed and variable production overheads that are incurred in converting material into finished goods. That is here your overheads. So you will take up the additional overheads. Other cost. In summary, you will not take this cost to your inventory and all this abnormal cost, storage cost, administrative overheads, selling cost, borrowing cost. You know, in warehouse you have this theft or pilferages. People steal things or rats and mice consume abnormal cost. Storage cost, meaning the cost to manage your store. Like you know, you have a chiller room. Correct. Exactly. These are not part of inventory. Administrative overheads, selling cost, borrowing cost incurred for a qualifying inventory item. If measured on a repetitive basis, borrowing cost may but not required to be capitalized. Actually, this is a little bit additionally technical. For me to elaborate this further, there is another standard, IAS 23, borrowing cost, we need to go on. Just simply think, interest, we will not take it. So all these technical interpretation comes in if you go into engage a large volume of inventory. So realizable value is of course the price of the organization receives for its inventory from market. We talked about it. That however, getting this inventory to market may involve additional expense, effort in repackaging, advertising, delivery and even repairing of damaged. You remember equation I gave? Future selling price minus estimated completion cost plus estimated selling expenses. This is the total of all this minus the selling price. That is realizable value or net realizable value. So that is that. And then this example is given just to make you understand. This item number 87, you should value at 70, 99, 12, but 102, 4. That's the basic simple analogy of the knowledge that we study. Assign recent cost to ending inventory correspond closely with the actual physical flow of the goods and services. 3 permitted method. Specific idea. What is the specific identification means? If you know exactly on a line by line item, identify and get the total. But if you are unable to arrive this, then you lose it. Specific item for inventory items that are not ordinarily interchangeable for goods and services produced and segregated for specific method. You separately you know, then you use this method. If not, FIFO in weighted average, cost of the latest purchase ends up in cost of ending inventory. Meaning, you have, as I gave that example, whatever the inventory item remaining in your warehouse after the consumption will be used as your closing inventory. The beginning months will be taken to your cost of sales. Now, just to give you a small interpretation here. If I use FIFO, on 1st of January, I have 200. I am talking about the cost. And on the 5th of January, I have issued 70. And on the 10th of January, I purchased another 150. On the 15th of January, I issued 125. Now, what is my closing stock? The closing stock is 200, 350 minus how much? 155? This is my closing stock. How I arrived using the FIFO method, meaning that I have taken this 70 from this 200. Now, when I have to take this 125, our life is very simple. I have 130 here. You see, 200 I had, 70 I have used, so I have 130. Now I am issuing how much? From that 130 I have used 125. How much is left? 5 is left. Then I have purchased another 150. That's how I got 150. This is a small interpretation of the use of FIFO. There are different detailed calculations which I don't believe we need. Inventory weighted average is the opposite. What you do is, you put everything into a pot, you jumble it out, and then you calculate the cost, average. Weighted average cost of all goods available for sale ends up in both ending inventory and cost of goods sold. Carrying amount of inventory sold is expense in same period as the related revenue. You remember, first I started with cost of goods sold. That cost of goods sold is the expense which is the carrying amount of that inventory which I have sold. And inventory adjustments such as losses, write-downs, lower of cost and NRV, write-down to reversal are recognized as an adjustment to the expense recognized in the period. Simple. This inventory adjustment, you will take it to profit and loss account. That's exactly what you need to understand. With this, I was able to cover the topics. Just to give my feedback on this, we discussed initially 5 topics, but then we had to increase one more. we discussed 6 topics. I would say only 30%. And I had to deliberately avoid certain technical aspects which is eventually needed, but due to the time and the amount of complexity, I had to avoid this. So, if you need any detailed questions of this, you are feel free to contact sir or me. I am more than happy to help you on this. With this, I would like to call of the day, and I will hand over to. No, we have to give now.
Thank you very much, Mohammed. I hope the training has been useful for all of you. So we'll just give away the to an extent. Okay. What could we have done better?
That's what. Because it was not much related to our field. It was completely related to something else.
Yeah, that actually
For manufacturing and all other things, I believe.
Yeah,
It's
the
my personal-
issue, brother, the way the scope is chosen, that is nature. In that we have to use in that way. However, we try to cover whatever the extent you all had on that day. But I don't deny or what you call yeah.
That's mean nobody from our finance team review this course with you or give suggestion or give something to enrich the course subjects, right?
So
Because I heard somebody from finance review the course and approve.
yeah. So what we did was that we whatever we are going to cover in the contents and all. Of course, we have not shared the detailed content with them, but we did share what are we going to cover under the various IAS. And then the other day, Mr. Haitham requested that we should cover IAS 40 also because that will be more relevant for all of us. Then we tried to include that as well. Right? But
Actually, now the feedback
yeah,
form which you give, there are some courses,
yeah.
something that
That
might
would
be
be-
more benefit for us.
Okay, so
Apart from
that's the
this, what-
reason we are also asking you that is there anything else that we can do to further complement and supplement what we have already done. And in any case, like Mohammed said, that we are open to if anybody has a particular issue that you want to contact Mohammed. So his expert guidance is available to all of you. It's not that we have finished the course and we are done with it. It's not like that. We will share his contact number with you in case anybody feels that we can add value or he can guide you in a better way. You are always welcome to contact Mr. Mohammed. So we leave that channel of communication always. But thank you very much for having us. Thank you. So we'll just give away the certificates. Please.